Well, good morning and thank you for joining our JobKeeper for Not-for-Profit session. My name's Tim Sandow. I'm a tax partner here at BDO and I will be joined by Andrew Tickle, who's an audit partner here at BDO as well. Just before we start, there are a few housekeeping things. Everybody is automatically on mute. And the presentation slides have been loaded into the handout pane, so you can click on those and access them if you would like to see them and look at them afterwards, or look at them as we're going through. You can submit questions in the questions pane, and we'll try to answer as many as possible as we go through. There have been quite a few questions that have already been submitted, and we have included those in the session as we go through. If you're experiencing any technical difficulties, then there is a website, support.goto.com/webinar. And after the session, we will be sending you a follow-up email with the slides if you didn't have a chance to download them during the session, a link to the recorded session, access to past and future webinars, and our contact details. So with that, we will make a start. It's actually, I guess, not surprising that we've had quite a few people who have registered for today's session and asked a lot of questions, even though the deadlines for making payments and applying for JobKeeper is approaching very quickly. And I guess that's just a reflection of the fact that there has been so much that's been changing and happening very, very quickly. It's been surprising how quickly this stuff has been rolled out. So today's session, we will effectively be walking through the JobKeeper provisions with a particular focus on what they mean for not-for-profit organisations. So we'll start off by looking at the ATO's approach. We'll look at the decline in turnover test, what's included, how do you calculate turnover, this one-in, all-in principle for employees. And then I'll be handing over to Andrew as we start talking about how we fund payments to employees. How do we account for the JobKeeper payments? What does my payroll system need to do? And then lastly, and importantly, what are the relevant dates? So the ATO's approach. Now, I guess the thing about these rules is that they have been implemented extremely quickly. The purpose of these rules is really to try and to get some cash into the economy to support people who have been heavily impacted by the COVID-19 pandemic. So because the rules have been rushed out quite quickly, there have been a lot of changes, a lot of clarifications. Funnily enough, it seems that Friday night seems to be the most regular time for the ATO and Treasury to publish new guidance, just so that we've got time to read it over the weekend. As I said, it's aimed at businesses impacted by the COVID-19 crisis, but you don't need to show that this was the case. So compared to some of the state initiatives where you do have to show that direct link to COVID-19, you don't need to for JobKeeper. I guess what's really important, and I've sat through a number of sessions now with the tax office and representatives from the tax office, and what I'm hearing constantly is them saying, if you're being reasonable and genuine in the way that you're applying the JobKeeper rules, then we will be too. Now, I guess that's a reflection of the fact that all of this is happening really quickly, and the ATO doesn't have time to issue rulings to people to give them certainty about whether they are eligible for JobKeeper. So what they're insisting people do is to document really carefully how you do your calculations, how you come to your conclusions, and whether that is reasonable. So if it's reasonable, then we can expect that the ATO will be reasonable as well. Now, some of the questions that we've been having, and once we start getting into how you work out the decline in turnover tests, is that you do need to be able to project what your revenue is going to be. And some people have been concerned about, well, what happens if I get that calculation wrong? You know, what happens if instead of a 15% reduction in my turnover, I end up at 14%? Well, the ATO's indicated that that's okay if you project a 15% fall in revenue and you end up increasing revenue, then they'll start asking questions about what was the reasonable basis that you use to do that calculation. They're also really interested in the time that you did that calculation. So it's going to be really important to have contemporaneous records. And I'm even suggesting to some clients, if you've got an Excel spreadsheet where you've done your calculations, maybe even email that to yourself or email it to the board or email it to somebody, just so you've got that really good record of the time, almost that date stamp, if you like, at that time when you did that calculation, so that in 12 or 18 months, if the ATO is to come back and say, let's have a look at the calculation, and you can say, well, here we are, this is what I was doing, this is the time that I was doing it, and at that stage, this is what was reasonable, even if it turns out to be different. The one thing the tax office doesn't like is schemes that manipulate the amount of JobKeeper you receive. So on the weekend, they published some guidance, and in that guidance, it was talking about the types of schemes they don't like, and that includes manipulating the timing of when you might invoice for something or receive payment for something. So if you're doing something that makes your month of April, for example, look particularly bad, and then things start picking up, and the only reason April was bad was because you manipulated when you invoiced for something, they don't like that. So it's all got to be, as I say, reasonable and genuine. So moving then on to the decline in turnover test. Now, one thing I'll say just before we get into this is just to make it clear that the JobKeeper scheme is not available to any government organisations, which includes local government bodies. That also means it doesn't apply to government schools. So when we talk about schools, as we go through the presentation, we'll be talking about non-government schools. The other thing which is particularly relevant for the not-for-profit industry is that for GST purposes, you can register sub-entities. So not-for-profit organisations can register sub-entities. That's purely for GST purposes. So because JobKeeper refers back to definitions in the Income Tax Act, when we're talking about entity in this context, we're talking about the legal entity. So you sort of have to, if you've registered sub-entities, you have to put all those back together to try and work out what is the turnover for the legal entity and then who are the employees of that legal entity. And I know there was a couple of questions that came through on that. One other thing, there's a lot of things that are really important. One thing here that's really important is you only need to pass this decline in turnover test once. So let's just say in April, you pass that test and then things start picking up. And let's just really hope that things do start picking up. There is this requirement to report on a monthly basis your turnover. But if your turnover starts picking up, that doesn't matter. You still qualify for JobKeeper through until the end of September. The monthly reporting requirement is purely for information purposes, and it's purely for the government to see how the economy is recovering. So it's important. You only have to pass this test once. Now, pretty much everyone would be aware the amount of the decline that we're looking at. If you're a charity registered with the ACNC, it's a 15% decline, and we'll talk about the tests in a minute. If you're a university or not non-government school, it's a 30% decline, or 50% if your turnover is over $1 billion. The really important thing that we've seen as we've been working through calculations with organisations is there is a lot of flexibility about how you calculate the decline. And while a good starting point is to have a look at how you're lodging your BASs, whether that's monthly or quarterly, cash or accruals, that doesn't matter. And we'll see in a minute, we'll go through an example in a minute where it doesn't matter if you've been lodging your BASs on a monthly basis and you want to do this calculation on a quarterly basis, that's fine. If you lodge on a cash basis and you do this calculation on an accruals basis or the other way around, that is absolutely fine. The only thing that you have to do is if you're doing a calculation for a month and you're doing it on, say, an accruals basis, when you look back 12 months and look at the comparison 12 months previously, you've got to do it on the same basis. So if you're doing a monthly accruals basis for, say, April this year, you do a monthly accruals basis for April in 2019. So you just have to be consistent, but it is really flexible, and that's actually really important as we try and look at how we might satisfy the test. So there is a basic test and there's an alternative test. So, and as I said, we'll have a look at an example in a minute, because I think an example does help to make this make sense. So the basic test is simply looking at the same month or quarter in 2020 and comparing it with 2019. So we're looking at, for example, April 2020 and comparing that with April 2019 to see if there's been a 15% decline in revenue. The first month you can use is March, so you can use the March results as well, March 2020 versus March 19, but you have to compare the same thing. Or you compare the quarter. So you're comparing in this case, it would be the April to June quarter 2020 to the April to June quarter in 2019. If you look at the basic test and you say, yes, I've had a 15% decline in revenue, you don't need to consider the alternative tests. Now, there has been a couple of questions that came through about the alternative tests. The alternative tests are there because effectively what we're saying here is there's been a change in the business. So when I look back 12 months, my business has changed so much in that 12-month period that just comparing April 2020 to April 2019 is not a fair comparison, because something has happened in the business over that 12 months which has changed. So this could be, in the first one, there's a new business that started. So what they do is they say, instead of going back and comparing just a blanket, just a flat 12 months ago, what was April 2020 looking like? Most of these tests say, look, a better, more applicable comparison is to go back and look at some averages or something else that gives us a better feel for what is the business like right now. So if you are new to business, if the business has only just started, if the charity's just started, then you look at there's actually two tests. You look at an average turnover since the business started, or the average over the last 3 months. If you've had an acquisition, a disposal, or a restructure of the business, you look at what did the business look like in the month after that event occurred, and then you compare that month to now. So if there was something that happened, say in September, you look at what did the month in October look like and what does it compare to now. I've actually seen this substantial increase in turnover tests being applied in a number of organisations, and including in a couple of not-for-profits. And this is, I guess, particularly relevant where, for example, the charity has done something and that's really started to increase the turnover. Maybe it's a new service line, a new initiative or something, and what we can see is that we've had this big increase. So we've had a 50% increase in turnover in the last 12 months, 25% in the last 6 months, or 12.5% increase in turnover in the last 3 months. If that happens, you look at the average turnover over the last 3 months and compare that to how it is now. I'm actually going to do an example about that because someone asked a question about how do you do that calculation. The frustrating thing about the guidance that's come out from the tax office so far, they've got really good examples on everything else apart from that one test about how you actually how do you calculate an increase in turnover. If there's been an irregular turnover, so this is where you've got more than a 50% difference between the highest quarter for your business during the year and the lowest quarter. So the highest quarter or the lowest quarter is sort of half of the highest quarter. You can do an average, but it can't be a seasonal business. So if your business is seasonal, they say you've got a comparison, an appropriate comparison 12 months ago, because you'd be at the same point in the cycle 12 months ago. And the last one there, I'm not sure how many charities this would be impacted by, but if the entity's been affected by drought or another natural disaster, you look at the same period in the year before the drought or the natural disaster was declared. Now, I know in some places, in Queensland and places, the drought was declared 4, 5, 6 years ago. And so in some cases, I know entities have to go back a number of years to try and find what an applicable pre-drought turnover would look like. Okay, so as I said, let's have a look at an example, because I think an example will help to make some sense of this. So I've just made up some numbers here. We've got numbers, so we can see there, we've just made up some numbers for turnover going back to April 2019 and then forecasting through to April 2020. And what you can see there is this business has had some initiatives, and the turnover has been growing through that period. And then when we get to April, it starts falling off. And once we get to May and June, it really starts to fall off. So just looking through these different types of tests to see whether we're going to pass. So if I just look at a basic test and just compare months, when I look at April 2020 to April 2019, I'm comparing $1,100 to $1,000. That's not a 15% decline in revenue. And so I'd say, oh, I actually don't pass. I'm not eligible for JobKeeper. But you can't just stop there. And if there's a key message I'd like everyone to take away from here is there are so many different ways you can do this test. You might be surprised that you do actually pass. So we can see this big drop off that's happening in May and June. So another way of doing this test might be to compare quarters. So if I compare the April to June quarter in 2019 with April to June in 2020, I'm comparing $2,000 with $3,200, and I do have a significant drop, and I passed the 15% test, so I do satisfy. As I said before, we passed the basic test, but we don't need to go on to the alternative test, but just to show how this alternative test does apply, because as I said, there's no nice example anywhere to show you how it works, and someone did ask the question. Let's just have a look at the growth in the last 3 months, because what we can see is that in January, February, March, things looked like they were going really well, and then we started falling off. So what it asks us to do is to look at, did we have a 12.5% growth in the last 3 months before our test month? Our test month is April, so did we have 12.5% growth in January, February, and March? Now, all it says is test from the beginning of January. Now, you could interpret that as comparing January to March. The ATO, and you won't find this written down anywhere, but the ATO's preferred view that they expressed in a webinar was they would prefer that you compare the month before. So you compare March with December to see whether there's been that 12.5% increase in revenue over that period. So when we do that, we find that we do. That means that we're into the test. The test then says we look at the average turnover for the last 3 months and compare that to our April month. And as we can see, when we do that calculation, we've actually got a 34% drop, which is more than 15%, so we're okay. As I said, the key message out of all of this is really to say there's so many different ways of doing this test, and as we'll see in a minute, so we've done this, we've looked at monthly, we've looked at quarterly, we've looked at one of the alternative tests. We could have also gone back to look at cash versus accruals, and as we'll see in a minute, we could also look to see what happens if we exclude government revenue to see what impact that has on our test. So I guess that's sort of a nice little segue into the next part of the topic, which is looking at how do you calculate your turnover. And there are a few things that are different for not-for-profits. So the starting point is looking at our GST turnover. So GST turnover also includes GST-free supplies. If you happen to be a charity that does exports, exporting goods or services, then they are included in your GST turnover. Somebody asked a question about whether a decline in an investment portfolio, as in a revaluation of an investment portfolio, and whether that counts. Unfortunately, it doesn't, because we're just looking here at GST turnover. So a revaluation of an investment portfolio wouldn't be taken into account. So starting point, as I said, it's the GST turnover, but then we exclude certain things. We exclude input tax supplies such as bank interest. For not-for-profits, and I haven't put this on the slide, but for not-for-profits, there are certain supplies that you make that you can choose to treat as being input taxed. So input tax means that you don't charge GST when you make the supply, and you don't claim a GST credit for the GST when you make purchases. So things like school tuck shops, where which are input taxed, are excluded, and things like certain fundraiser dinners where you choose for those to be input taxed would also be excluded. What that means is that if your only business is doing fundraisers or doing a school tuck shop, if you've only got input tax supplies, you actually don't have a turnover. So you'd be comparing 0 to 0. So unfortunately, that means you wouldn't be eligible. The one thing I'd probably just say about school tuck shops is you might also just have to think about that comment I had right at the very start about whether they are a sub-entity that's been registered just for GST purposes, because for JobKeeper, you do have to look at the entire entity. Also excluded are payments that are made for no supply. So for everybody, if you receive a government grant, they're excluded unless they're conditional on the entity undertaking an action. So I guess the good way of looking at this is if the government's given you a grant, if they haven't included GST, it usually means that they don't expect there to be a supply. If they have included GST, then there is a supply. So if there's no GST on the government grant, it's likely to be excluded from GST turnover. So that applies to everyone. Now, when we get into the AC/NC charities, they also include tax-deductible donations if you're a deductible gift recipient. If you're not a DGR, you have to include gifts of money, property with a value over $5,000 in any listed company shares, listed Australian shares. Tax-deductible donations, you only get a donation if the value of the property is over $5,000 as well. So effectively, it's the same thing. So all of those numbers have to come into be taken into account in turnover. If they're not on your BAS, then you have to look for some other source, whether that's a bank statement or somewhere else to try and find those numbers. Now, the announcement that they've just made, and they particularly put out on the weekend, was that for AC/NC charities, apart from universities and schools, you can also exclude supplies made to an Australian government agency, a local government body, or the UN, if the charity makes an irrevocable election. So this is a choice. So when I was talking a minute ago about those turnover calculations, you do have a choice to make about whether you want to exclude supplies made to Australian government agencies. So effectively what the test is here is whether the consideration for the supply is provided by an Australian government agency. Now that's state or federal. A few people have asked about whether that includes NDIS income. I guess if the consideration for NDIS is coming from an Australian government agency, then it would be excluded. But if you want to make this choice to exclude that income, you do actually have to make this election, and the election has to be given to the tax office within 7 days of effectively the announcement from last Friday. So that means that by this Friday, so by the 8th of May on Friday, you have to have made the election and told the ATO whether you're excluding Australian government income. The next slide we've got here is about this one-in, all-in principle for employees. So once we've gone through the calculations, we've worked out that we've had a 15% decline in revenue. The next thing then is to try and identify all of the employees that we need to nominate who are going to be eligible for JobKeeper. This one-in, all-in principle means that you have to nominate all of your employees who are eligible. You can't pick and choose who's there. There is a really big overlap here with the Fair Work Act, and so there's a lot of wording that's used around employees who have been stood down versus being let go, and so on. And if they've been let go, you may rehire them. One thing, I don't want to sound too harsh here, but if you have let go employees, You may choose to bring them back and to rehire them if you're eligible for JobKeeper. The one in all in principle doesn't mean you have to rehire all of the employees that you've let go. If you decide that you're not going to rehire them, that's okay. But if you do, all of those eligible employees have to be given the opportunity to be nominated. So that means they have to receive a written notice from the employer saying that they have been nominated for JobKeeper. Now, eligible employees, it's tested at 1 March 2020. It includes permanent, full-time, part-time employees. The one where we're getting a lot of questions about is around long-term casual employees who must have been employed on a regular and systematic basis for the last 12 months. They also can't be a permanent employee of another employer. So what you might find is when you're sending these notices out, when you're getting them back, they might be saying, I'm a permanent employee somewhere else. And so I'm not eligible in your organisation. Now, that actually, sometimes that's good, sometimes that's bad, because I know there's been some organisations that have been looking at how they're going to fund the JobKeeper until they get reimbursed by the tax office, and they've actually, when they've got the forms back from the employees, they've worked out there's not as many people that they have to fund as they thought they would have to. As far as working out long-term casual employees, regular and systematic is used in the Fair Work Act. I think if there's any doubt that you've got, you may need to see an employment lawyer to work out whether these people are long-term casual employees. I did hear a conversation recently where they were saying, it was by an employment lawyer, saying if someone, you effectively are looking at long-term versus ad hoc employees. And an ad hoc is someone that just comes in very occasionally to do something. Fair Work will often view someone who's not ad hoc as being a long-term casual employee. Now, I'm not an employment lawyer. I can't give legal advice. And I would suggest that if you've got any that you're on the border about, that you do seek some legal advice. The person must be at least 16 years old. Now, they've just recently said that if you're 16 or 17-year-old, they can't be in full-time study, and they must be independent. And those terms are defined in the Social Security Act. So it's really looking at people who may have been married, but have children, or be unable to live at home. Now, if you've got someone who you've already paid JobKeeper to before these rules changed in the first 2 fortnights, that's okay. That rule only applies for the future. There's also some citizenship and residency requirements, and you can't be in receipt of government parental leave, dad and partner pay, or on workers' compensation for total incapacity. Now, somebody asked the question, what happens if that person's on, you've got an employee who's on unpaid leave, say they're on maternity leave. If you're on unpaid leave, you still qualify as an eligible employee as long as you're not in receipt of the government parental leave. And the person has to be agreed by you. Now, there is this also for not-for-profits. So if you remember a few minutes ago, I talked about the election you can make to say that you're not going to include government funding in your turnover test. So if you decide to take out that government turnover, you could also decide if you've got employees who effectively are fully funded by that government money, you can choose to exclude those employees. So someone asked the question about what happens if you're in this sort of situation, you claim JobKeeper, does that mean the money effectively goes back to the government because your cost of providing the service has gone down? I guess this is what this particular point is aimed at, and that's basically saying that, yeah, if you're excluding the government turnover, you can also exclude those employees who are fully funded by that government revenue. I guess one last point here is that there is a wage condition, which is that you must pay the equivalent of $1,500 a fortnight It doesn't matter if your normal pay cycle is weekly, monthly, or on a different fortnight from the JobKeeper fortnight, as long as you keep the records to show that you've actually paid the people at least $1,500 a fortnight. And that includes salary and wages and anything they salary sacrifice, but it doesn't include the normal superannuation SGC. So it's got to be, unless it's salary sacrifice super. And this is just about where I'm going to hand over to Andrew. So how do we actually fund the payments to the employees? So every month you'll lodge a monthly declaration, which is due by the 7th of the following month, and the tax officer said they must pay you by the 14th. But I guess that what that means is that you will have those couple of weeks from when you've been paying employees earlier in the month, and you'll need to fund that until you get paid by the ATO by no later than the 14th of the following month. So Andrew, I will hand over to you.
Thanks, Tim, and good morning, everyone. Yeah, the cash flow impact is obviously something that most of you will have been considering already, but I thought it was just worth reiterating some of the potential options. And really, we're seeing probably three groups of not-for-profits. Some having existing reserves that they can draw on. That's obviously the best case scenario, where you've got cash investments, something that you can use to fund this in a short-term basis. Some of you have got the funding through same time cash flow, so that there's still some cash flow coming through, and rather than drawing down on existing reserves, you can fund it through cash that is coming in the door. And the final is that you've got to consider funding through potentially external sources. Part of the implications of all of this being rolled out quite quickly is that the banks are being asked to come along in a variety of manners, and this is one of those. I had a quick look around at some bank websites yesterday in terms of what they're looking, how they're looking to fund this, and effectively they're doing it through extended overdrafts. Now, the other side of it is in the not-for-profit sector, as we're well aware, that not all of you have those types of relationships with your bank. A number of not-for-profits are not necessarily used to going out and obtaining external funding. Those options are on the table. If you have a relationship with a good relationship with your bank, that is certainly something that you can speak to them about. All of the things that we've been talking about, i.e. showing that you qualify, the employees, the impact, those are the types of, that's the information that you'll likely need to present to your bank to extend an overdraft to allow you to fund the 1 or 2 weeks worth, or potentially longer, that you'll need to fund the wages until the government reimburses you. Now, I guess the BDO sales pitch, if you have any of those issues, our finance broking team would be happy to work with you where you don't have a relationship with your bank, to work through that. But pulling that all together is, obviously, having a short-term cash flow document that you can work with to understand what the expected timing of those cash flows will be, allow management and your board to make a reasonable assessment. We're obviously at the very, very tail end of that, given that this week's an important week for everyone to be paid. So these will be things that you'll need to work through over the next couple of days. But again, feel free to give us a shout if you need some assistance to work through that. Onto the next slide, Tim. Thanks for that. In terms of the actual financial reporting aspects of the JobKeeper payment, one thing we haven't necessarily touched on, because it's pretty well understood, I think, is that there's effectively 2 types of payment within the JobKeeper scheme, and that's important to understand before we step through into the accounting impact. What I will say at the top, though, is similar to the tax elements of it, the application elements where there's new information coming out quickly. The accounting for this is still being developed, still being talked about. I wouldn't say that there's a level of consensus quite yet, but we can certainly talk you through where the BDO perspective and some of the things that we're considering are, and things for you to keep in mind. So two types of payment. You've effectively got the top-up type. So these are people that might be casual or currently earning less than $1,500 per week, and that's where you're potentially making a small top-up payment and being funded by the government for the full $1,500 a week, or the full $1,500 a week is being provided to you for that casual staff member. Versus the pure, what we're calling sort of the pure subsidy. So that's where you've got employees that are being paid more than $1,500 per week, and the organisation is just receiving that $1,500 directly. So they're really there's potentially two different treatments there. The top up potentially could be argued to be an agent type of arrangement. So you're almost just operating as a pass through for the government. Almost I think one of the ways they rolled this out was particularly for casuals is taking the weight off Centrelink and saying, well, we can use organisations to pass through this $1,500. In that case, you're not potentially not at risk for that payment. So that may potentially change the accounting treatment given the principal versus agent comparison. Principal versus agent being if you're not at risk, you can net the payment, the $1,500 that you receive, against the expense that you incur, so that you show actually no impact at all in your financial statements. You've then got the pure subsidy, which you are at risk for the full you are at risk for the full salary and wage payment, and the payment is effectively, as we've called it, a pure subsidy for that. What's worth understanding, and you might hear and see some of this as you sort of talk to your colleagues in the financial reporting areas, is the for-profits have actually got a different standard, AASB 120 government grants, and that provides more flexibility for them in terms of how they report on that. That standard doesn't apply to not-for-profits, so you may see some discussion around that. The implication there is that within that standard there is the ability to net or gross up as required. So what we're getting at there is that there might potentially be two different accounting treatments for the one JobKeeper scheme, being one treatment for those casuals and people being paid under $1,500 and those being paid the full amount. So some implications to think about there. As with any accounting issue, a financial reporting issue, the key thing is whether it's material or not, particularly if you're being audited. So if you've got the majority of your staff being permanent, being paid that pure subsidy, and you've got one or two casuals, it's probably not going to be material, and therefore the treatment probably makes more sense to keep it consistent. And if it's immaterial from an audit perspective, I think everyone would be happy to tick it and move on. On the flip side, if you've got a predominantly casual workforce that you're making those payments for, being clearer about what that position would be. Now, every organisation will come to a different position as to whether they're a principal versus agent in some of this, but keeping that in mind, that may be a decision to choose. The other thing to consider is whether you, in doing all of this, and you might think, well, no, I want to show it as income. It is income. The other thing to consider is just the presentation of your financial reports. Netting it off and showing less of an impact will more clearly show that there has been a dramatic impact on your revenue, rather than showing an inflated revenue figure for the year. We often we know that is one of the challenges for NFPs, is not showing a distorted result as a result of something showing larger revenues, because revenues can often be used as a stick against you. It's one less thing that you need to explain. And finally, how will you keep track of all of this? How will your systems and processes keep track of who is in one category versus the next? So onto the next slide, thanks. Tim. Just quickly in terms of some of the system issues that you might want to consider, and there's a couple there in terms of payroll and then just generally. Payroll, single touch payroll is being used to facilitate a lot of this. So making sure that your payroll system either allows you to interact with or provides you with information for that. Considering that, particularly whether your payroll system can or whether you need to work around the superannuation requirements. So particularly for those top-up payments where you're not obliged to pay superannuation, if you process it through your payroll system, is the payroll system automatically just picking up and applying superannuation to that? Do you need to do some modifications to that or some workarounds, or are you using a system that is has been modifying it? I know the Xeros and the MIBES of the world, I believe, are updating their payroll systems to pick up the JobKeeper payment versus the standard wage payment. And then the financial reporting and other system issues, as Tim mentioned, for the ATO and for your auditors, making sure you've just got good record keeping around the decisions you've made and the reasons why you believe you've qualified. Making sure your financial systems have got reliable information around revenue reporting to ensure appropriate qualification. As Tim talked through, there's lots of different ways you can get in and out of that, but you'll need to make sure you've got some good reliable information to base those qualification decisions on. I think there's a couple of questions that we might touch on in a second to get there. And then finally, that capture of the split between top up and pure subsidy. So making sure that you've got systems. Now that system could be your financial reporting system, or it could be purely a file note off to the side for those two particular pieces. So they're some of the system issues that we've tagged to think of. Obviously, each of your individual circumstances will guide how complicated or how potentially easy that might be. And Tim, you're going to just quickly talk through the final dates, and then we'll rattle through just a couple of quick questions that we've received over the course of this morning.
Thanks, Andrew. So as far as dates go, so from the 20th of April, you were able to start enrolling in JobKeeper. From the 4th of May, you're able to start identifying eligible employees. By the 8th of May, you must have paid your employees for the April fortnights. So originally, you had to have paid all of your employees by the end of April. But now they've said that it has to be by the 8th of May. Now, someone asked a question about, can you just do it, the end of May payroll? No, you've got to have actually paid them. If you want to claim for the April fortnights, you have to have actually paid them by the 8th of May. There is a date of the 31st of May being the final date to enrol if you want to claim for the fortnights in April and May. I think the consensus is that's a bit of a dud date, because by then you would have had to have paid everyone. And so you would have wanted to have notified the ATO well and truly by then, so that they can reimburse you. Someone did ask the question about whether a monthly declaration is required on the 7th of May. The rules require a monthly declaration so that you can be paid by the tax office or reimbursed by the tax office. I haven't seen anything on the ATO's website to say you don't have to do 7th of May, so I'd be encouraging you to do the 7th of May monthly declaration, just to make sure there's no excuse for the ATO to not reimburse you. And then ongoing, you need to pay the employees by the end of each fortnight, or whatever your pay cycle is, and continue to be lodging these monthly business declarations. So Andrew, do have a 1 or 2 minutes just for some questions. I did notice that someone put a question up around NDIS or NDIA, and look, I really do think that it gets back to the contract that you've got. All the legislation says is asked about whether the consideration for the supply is provided by the Australian government agency. So I think that will come down to the actual contract that you've got and how the funds flow. So that's probably a more detailed question. Someone's just asked the question about what happens if you pay employees monthly rather than quarterly. That's okay. You just need to show that that person's got at least $1,500 a fortnight, or the equivalent of $1,500 a fortnight.
Thanks, Tim. Couple of questions. relate to the qualification, refund of revenue. In particular, grant revenue that at the end of the year might need to be refunded because it hasn't been completely spent. How are those credit notes, returns of revenues? How are you seeing those being treated within the qualification?
Yeah, look, I think that's an interesting question, Andrew. I think turnover only looks at the top line, which is about amounts received. It doesn't take into account amounts paid back. So I'm not sure that amounts paid back, well, put it this way, maybe that's when you start looking at an accruals basis to see whether you've done everything you needed to do to earn that income, and maybe you could go back and apply that basis for doing the calculation.
Yeah. Now, obviously, the accrual basis is the sort of the basic accounting implications, as you'd all be aware. Not-for-profits have got their new revenue standards applying this year as well, which would dictate when you recognise revenue. Now, that's obviously different again to the GST treatment, but there are some specific things to potentially work through in terms of those refunds of revenue, and whether you have actually earned that revenue on an accruals basis would be the test to look at. But potentially the other approach to take, I would say, Tim, would be considering whether that's government, whether you want to opt out of your government income anyway, whether that is advantageous to qualify, because those government grants are typically supply where you've got GST being remitted as well.
I think that's right, Andrew. I think the key message there is there's lots of different ways of doing the calculation, and I'm sure that we can find a way which gives us the right result.
Yeah.
I've also just noticed that we've just gone past 11 o'clock. So there are some questions still coming through. I can see one on the screen about consolidatable groups. Consolidatable groups, it's a tax term rather than an accounting term. So we need to go back to whether there's 100% owned group for tax purposes. But Andrew, we might just have to leave it there, I think. Unfortunately, we haven't been able to answer all the questions, but we will be back in touch, as I said, afterwards with a copy of the slides and our contact details. Thank you all very much for attending the session this morning. And yes, if you've got any questions afterwards, please feel free to contact Andrew or myself. Thank you very much and good morning.
Thanks, guys.